very good morning, ladies and gentlemen. It is an absolute honor to welcome all of you to Research and Ranking's Elite Club Conclave, meant exclusively for our premium customers today. My name is Raj Mehta, and I'm an Associate Vice President with the company.
And my name is Merlin Susanna, and I'm a research analyst. And for today's beautiful event, we will be your hosts. Now, the primary objective of this conclave is to meet, interact, and nurture the bond that we share with you all, and also put faces to the many names you all might have heard of since your association with us.
The last time when we had this conclave was back in February 2020, a little before a certain virus confined us to our homes. Now, in our past events that we've done, we've had a 75-year-old investor introducing a 19-year-old investor. This goes on to say that a lot of our investors come from a strong investing background, while many others are just starting off in their wealth creation journey. In one of our past events as well, we've had participants flying in from Trichy, Kolkata, Rajkot, Chandigarh, Delhi, for all you know. What's interesting is your hosts for today have arrived in Bombay just yesterday from Bangalore, just like many of us here have come from various cities across the country.
But there is one thing that is common amongst all of us. It is that will, it is that inclination, and it is that desire to know the intricacies of the market. Now, there is a bigger objective, and that is to be aware, to be informed, and to be updated. As they say, the more you share, the more you learn, the more you learn, the more you grow.
Now, we know our roles today, and we will try to play it to perfection. You may be asking what exactly is the role that you'd be playing today, or what exactly is it that you should be expecting in today's conclave. Now, the event aims at teaching you the principles of growth versus value investing. We'll also try to cover how our country has traversed through the years and come a long way. Now, what's exciting is this is just the beginning. We will also talk about how the various intricacies are exposed to your portfolio. We'll absolutely not go on a stock level for sure, but we will try and cover the overall flavor and texture of all the items that could affect the returns on your portfolio. You believe me when I say this, there's a lot in store for all of us today. But before we even begin, I have a very small ask, but a very prominent ask from all of you. Now, this is going to be that you make as many notes as possible from today's event. You ask as many questions as you have from today's event. And you go back with a smile while we present to you a token of appreciation for a job well done today.
As they say, a well-begun job is half done, and there is nothing better than setting the tone for today's event. Let's move on to today's opening section.
Yeah.
As recently as the 1990s, most of the world thought of India as an exotic land of saffron-robed priests, snake charmers, Maharajas, Taj Mahal. Now, there is nothing wrong with this perception, but the last 2 decades have utterly transformed these stereotypes. While India's exotic features remain an important part of the country's fabric and makes us distinguished from other countries, it is the economic India that has taken the front seat. In its 7th decade of independence, India stands at the cusp of a major change, a transformation that leads to unprecedented economic growth. So in our opening section, we'll look back and see how GDP and market capitalization have changed over the last 2 decades, how ownership structures have changed, and how quickly different sectors are changing.
Now, the person who will be presenting this session to us today is a visionary leader. He's the chief architect at Research and Ranking. He holds a master's degree in international trade and finance from the United Kingdom. He's also a qualified company secretary and a law graduate. He has over a decade and a half of experience in building businesses from the ground up and successfully growing them as well. From the beginning, his only focus has been long-term wealth creation through equity investing. Now, what our intro did not cover about this individual is he's much more than a businessman. He's much more than someone who's a mentor to all of us. He's much more than that guru, the guiding light that we look up to every now and then. He's much more than a chairman of a group of companies. He's much, much more than you and I can see today. Because behind the drive of this team and the interest at that side, there's something that has to bind us together. He is that binding glue, that binding object. Now, while he plays that role very silently but very, very effectively, not many of us in the investment advisory space confidently say that their mission statement is to educate and empower the investors to become the billionaires of tomorrow. But this person is different, and he's unlike anyone that we've ever met till date. Ladies and gentlemen, let's put our hands together and welcome the founder and director of Research and Ranking, Mr. Manish Goel, by giving him a standing ovation, please.
Thank you, Raj. Thank you, Merlin. You guys give such a detailed introduction. Then even if someone is not under pressure, you bring him under pressure. Good morning, all. Good morning. So happy to meet you all finally. This is the third time we have planned this event. Last to last time, March 2021. Obviously, reason known to all of us. We couldn't organize, although we had sent out invitation. After that, next time, Jan 2022, just a few months back, again we planned the event, but we couldn't do it. So this time, there's a reason why I'm sharing this. First, obviously, we are meeting after a gap of 2 years, so we are really happy, excited to meet you all. And there's another reason. This time, how we have done that, people who joined us after Jan 2020, only they got invitation for this event. Because people who joined us before Jan 2020, they must have got invitation in the past. So this is the first time you all have received invitation. So if you have a friend or a colleague or someone known to you who had joined R&R before Jan 2020, and you happen to talk to him about this event, and the person says, I didn't get invite, please tell him that he will receive the recording for sure, and we'll plan the next one at the earliest possible. Because since we had these two instances, we didn't want to take chance. So we decided to, break it into two parts, right? So just in case. But they'll surely receive the recording, and we'll plan the next one at the earliest possible, as I said. So, my job is to tell you a little bit more about India than what you know, or at least the investing profile of this country. Before I come to that, I would like to ask each one of you a simple question, or we'll solve a small calculation, which is very simple, as I said. We'll not make it too difficult. So 20 by 20. 20 multiplied by 20 is how much? 400. 20 multiplied by 20 and again multiplied by 20 is how much? 8,000. Not 6,000, 8,000. One more time, and last time. 20 multiplied by 20, multiplied by 20, multiplied by 20. Huh? 1,60,000. So whether it is a simple calculation or a difficult one, although it was not very difficult one, but we could have made it more difficult, and still the answer remains the same, right? When we look at this data and this data, Nifty in FY21, Nifty in FY22, these are yearly returns delivered by the indices in last 20 years, in last 2 years, 21 and 22. So when we look at these two data points, and we ask you a simple question, how much did you make? And certainly I'm not talking about a 2% or 5% outperformance or underperformance. Because we are looking at yearly figures. We are not looking at 10-year data or 20 years data. We are looking at yearly figures. So 2%, 5% outperformance, underperformance is fine. But answer, as we just saw, it was the same. Here, it will not be the same. Right? It will not be the same. There will certainly be a lot who will say, I made much more than this. Right? I made more than 72%. There will certainly be a bigger lot who will say, I made much, much, much lesser than this. So it could be 50%, 40%, 60%, any number. Similarly, for FY 2022, it is 18%, but for most investors, it will be either lower than 18%, or for a few investors, could be even higher than 18%. 25%, 30%, any number. So, till now, it's not too much of a problem. Because ultimately, if market delivered 80%, 70%, I made 60%, it is fine. A market delivered, let's say 18%, I made 15%, or 12%, or 25%, fine. Now, understand this. Last 2 months, April 2022 and May 2022. Data updated till May 25th May 2022. So if we look at this number, which is again Nifty performance, April 2022 till 25th May, is minus 9.46%. Again, I am repeating what I just said, 2%, 5% underperformance. In this case, it's very difficult that there will be someone who would say, I made more than this. But 2%, 5% underperformance is fine. But yeah, there will be a lot of investors who will say they lost much more than this. And there is a reason why, because there is a general tendency to keep adding more the ones that have gone down the maximum. So as an investor, the mistake we make, most of the investors make, they add the ones that have gone down the maximum, and at the same time keep booking profits or keep exiting the ones that have gone up, thinking if I buy something which is 20%, 40%, 50% lower, I'll make more, right? But it doesn't happen always. So yeah, here, as I said, this 2 months data is a big reason to worry for most of the investors. Right? 2 months, we have lost 10%, 15%. In some cases, a client would say we have lost 20%. Investor would say we have lost 20%. It's a big reason to worry. Let's look at what are we worried about as an investor. What are we worried about as an investor? Interest rates going up, inflation going up, there is continuous FII selling, geopolitical issues, recession in developed countries, or GDP growth going down in our country. There could be more, but these are, I would say, top 5 reasons, right? We are worried about these 5 reasons, right? So we'll solve all these reasons today. No need to worry. After this session, after this event, no need to worry. We'll solve everything today. Before we do that, let's understand we are worried about interest rate going up, inflation going up, geopolitical issues, recession in developed countries, etc., etc. And we'll solve that for you, as I promised. But before we do that, let's understand what are we not looking at. What are we not looking at? We are not looking at the big picture. So here we have data for last 20 years, GDP data, market cap, Nifty and Nifty EPS. So there are 4 blocks here. Each block has data for 5 years. Nominal GDP growth between 2002 to 2006, financial year, 2, 3, 4, 5, 6, right? 5 years. 10.8%. Market cap in that period, market cap, not EPS, market cap grew almost 38%. Nifty CAGR, almost 25%. Nifty EPS, almost 19%. Right? Most of us know about that bull run between 2003 to 2005. I mean, people who were active as an investor those years, they would certainly remember that period. 2007 to 11, not too bad. Nominal GDP almost 12.5%, 12.4%. Market cap 14%, Nifty little lower than 10%, and EPS growth was almost 6%. Third block, 2012 to 16, GDP 9.5, market cap 8.8, Nifty 6.12, and Nifty EPS 2.67%. Fourth block and the last block, 5%, 10.95%, 13.35%, and 4.82%. This 5.17% GDP was mainly because of 2021 degrowth. 2021 GDP degrowth. Otherwise, even this would have been in the range of 10-11%. Now, this is the most exciting year in terms of growth. FY 2022. GDP almost 20%. Market cap 30%, Nifty almost 20%, 19.37%, and Nifty EPS 33.95%. So as an investor, we want to invest in a year like FY 2022, or we want to invest during this period, 2002 to 2006, right? Which is not possible. Nobody can time the market. So you can't certainly time it this way that next year is going to be a big year or a good year, I'll invest, and next to next year will not be a very good year, I'll not invest. It's not possible, it's not practical. Rather, what we can do, we can look at, on the right hand side, we have now 21 years data, which is 2002 till 2022. 22. 21 years data. GDP 12%, market cap year on year, CAGR growth we are talking about, 19.63%. Nifty almost 14% and Nifty EPS more than 11%. So here you can see GDP, Nifty and Nifty EPS are almost in the same range. In between there will be a year when, let's say, GDP goes up by 12%, but Nifty EPS doesn't go up that much. Or markets deliver whatever, 30%. It could be. But what we should look at the long-term averages. Because here, what I said a while back is not true. If Nifty CAGR for 21 years is 13.95%, one can certainly expect 5, 6, 7, 8% outperformance, right? So 7, 8% outperformance or return over and above this is that range of anything between 20 to, I would say, 25%. 20 to 25% is possible. Nifty has delivered 13.95%. And yes, if one can take advantage of such periods which we keep getting, 10% fall, 15% fall, probably 20% fall, then this 20 odd percent or 20 to 22% can become slightly higher. So it could be Because on that investment which you make when the markets are down, certainly compounding is going to be higher, right? So if one takes advantage of such periods, then this 19.95 plus 6.7 could become plus 10.11. 20 to 25% compounding is a lot of money. Is a lot of money. And mind you, this has happened despite all the challenges, wars, recessions, geopolitical issues. In over 2 decades, last 2 decades. This kind of performance over 2 decades, despite all the challenges. Right? So this is what we miss as an investor, the big picture. What can we do? What should we do to ensure that we don't miss the big picture? So these are our 4 focus areas. This is the first one. I understand I have only 45 minutes or so. If I had 1 hour 45 minutes, I would have spent at least an hour on this. 4 focus areas. So there will be a lot of videos. We keep producing videos on focus areas or focus areas. And we keep talking about these 4 focus areas. So it's a strong recommendation that please, please, please do watch our videos on 4 focus areas. As I said today, because we don't have that much time, I'll not be able to talk about in detail, but there are videos available, our videos. So the first one is stay away from 6 financial diseases, and all 6 are mentioned here. The second one is not all years are alike. We just saw that there was a 5-year block, Nifty delivered 25%, and there was another block, Nifty delivered only 10%. Not all years are alike. And hence what successful investors do, they take advantage of, every crisis you can say, or every opportunity in crisis you can say. In the short run, markets are driven by sentiments and liquidity, and in the long run by fundamentals. We know about it, right? During 2020, after April, May 2020, till I would say June 21, that 1 year or almost 1 year, nobody really bothered about if let's say valuation is going high. Nobody really bothered about. Right? There was a lot of liquidity. Sentiments were very positive, you can say. Right? Mainly there was a lot of liquidity, and everybody had time. Right? It was work from home for most of us, not for me, but yeah, for most of our colleagues as well, it was work from home. Now, certainly, markets are looking at lot more data points, lot more developments. So hence we said in the long run markets are driven by fundamentals. You always own and cherish a few. Too many are a crowd to manage. Right? So most investors, they make this mistake. 100 stocks portfolio, 200 stocks portfolio, not possible. Wealth creation is not possible. Continuous churning, I have these 5, I sell, next me buy the other 5. Not possible. Not possible. You have a limited number, which is, I would say, anything between 20 to 30. You know enough about the businesses. Yes, churning is definitely, going to be there, but not too much churning. Not what I just said a while back, that I keep booking the ones that are giving me some upside to buy more that have gone down the maximum. Not that churning. Not that churning. There is a reason, business didn't perform to the extent it should have performed, and hence we are exiting. That should be the logic. But since I can't talk much about the 4 focus areas, simply put, what I would recommend, we should give more importance or respect to data, knowledge, and education. And certainly, we should not give too much importance to news all the time, rumors, and only price action. Only price action. 100 has become 200 or 500, it's a good company. 100 has gone down to 60, it's a bad company. We should not do that. Any investor should not do that. So, there's a reason why we added this slide. In all the presentations today, all the presentations, this one and the other presentations, we are going to share relevant data points and insights with an objective to make you a more educated, informed, empowered investor. And if we could make you even 1% better investor, you are already a successful investor, I understand that. But if we could make you even 1% better investor today, then we'll take it as mission accomplished. And there is a question we have added in today's feedback form. Please, it's a request, please do answer that question. It means a lot. If we could make you even 1% better investor today. There is a question in the feedback form. It's a request, please answer that. So we looked at there were some worries, interest rate going up, inflation going up, etc., etc. So let's look at some data points to understand if our fears are real. This is the first one, and most people are worried about it. Inflation going up, right? As an investor, we are worried about inflation going up. Now let's look at 20 years data, and the range is 3.33%, what it was in 2017, and as high as almost 12%, what it was in 2008-9. But if you look at long-term average, the long-term average is 6.31%. Currently, April 2022, it was 7.8%. Not for the full year, but the April 2022 for that month was 7.8%. As I look at it, it's going, higher. Certainly, what it was in last 2, 3 years, 4 years. But what we need to understand, two things. First, long-term average is 6.13%, not 6.13, 6.31%. Long-term average is 6.31%. As a country, GDP growing, 21 years data we just looked at, comes close to 12.4%. Right? Here we have export figures year on year, and the last year 2022 data updated till Feb 2022, the number was $601 billion. The next slide we have India's overall import. $683 billion. Right? So what I'm trying to communicate, in a country like India, where GDP growing almost 12% year on year, some years could be lower than 12%, and some years we just look at it was higher than 12%. In a country like India, inflation can never be 2, 3, 4% types if country has to grow at 12%. So ours is a demand-led inflation or growth-led inflation. So although there is no thumb rule, but if inflation rate multiplied by 2 is growth rate, it should not be a big reason to worry. I'm repeating, there is no thumb rule. But that's how one can look at it. Because if a country has to grow 12%, 13%, certainly there will be inflation. Right? The other data point, what I just showed, it shouldn't be this way that import is 600 and export is only 200. Right? The same problem, what we are seeing in Sri Lanka. This is the problem they are facing. There is no export, only import. And if there is no export, where to get money from? For import. So luckily, in our country, we are giving enough importance to the fact that we should reach $1 trillion mark at the earliest possible. Right? Look at China. They are almost 5 times or more than 5 times. And even in their case, services export is not much. So it's mainly goods. In our case, out of 600, $200 billion services export, remaining is merchandise or goods. So we are at 400 merchandise. Overall 600. China is 6 times higher. So our first milestone is 1 trillion, which is possible, right? And if we have as much export as we are importing, or more than that, then at least that problem is not going to be there. That tomorrow we will not have money for import. And if a country is growing double the rate, inflation is 6%, GDP growth 12%, double the rate, then I would call it growth-led or growth-led inflation, demand-led inflation. Certainly not wrong policy decisions-led inflation. And if we want to grow, if we want to continue growing at 12%, let's accept the fact it will not be 2-3%. It will not be 2-3%. There was a period in between when the inflation was 10-11%, but GDP was not really growing 22%. That was the period when there was a little bit of a worry, but not in the current situation. Right? The other one is interest rates going up. Again, 20 years data. And the long-term average, 20 years average comes 6.43%. One doesn't have to be really an economist to understand if inflation is going to be in the range of, let's say, 6%, interest rates cannot be at 4% or 4.5%. It's bound to go up. Currently, it's a negative real interest rate period, which is fine for a quarter or 2 quarters. It is possible. But gradually, inflation has to come down a little bit in the range of 6% or so from the current level of 7.8%. And interest rates will also slowly move higher. From 4 to 4.4 is already done. And they'll certainly go higher. Higher than 4.4%. 5%, 5.5%. Right? The third worry was continuous FII selling. Again, 20 years data, year on year, how much FII buying or selling has been there. Year on year. So 21 certainly, 22, FY 2022. The withdrawal figure is almost $19 billion, which is in rupee terms about 1.3, 1.4 lakh crore. And current year, till now, which is April and May, and hence the Nifty was down by almost 10% in 2 months. Current year, April and May 2023, they have already sold worth $7 billion. But just look at other years, year on year, how much they have pumped in. More important, look at this. March 2010, total market capitalization was 62 lakh crore. March 2015 was 102 lakh crore, and March 2022, 31st March, it was 264 lakh crore. And look at the FII figures. Look at the FII figures. Are they really selling? 52 lakh worth of shares they have. And for this year figure, we just looked at $7 billion is about 50,000 crore, which is 1%. Total value is 52 lakh crore, 1%. 1% of total. Hardly anything. Right? We also churn our portfolio, we also sell. If our wife says she wants a new necklace, even for that reason, one would sell 1-2%. At least I would do that. 1-2%. We are worried about this. FIIs are selling. They are selling. But it's a normal adjustment, readjustment. Interest rate in America going higher. They want to probably book some profit. Right? They have already increased their holding from 15.5% to almost 20%. In value terms, as I said, almost 52 lakh crore they have. So should it be this way that they are never allowed to sell? You have 50 lakh crore or you have 200 lakh crore, you will not sell. Not even 1%. Not possible practically, right? This we can ignore. A little bit in detail, we have explained the ownership structure. Now, even if there was a reason to worry, FII is selling. Now look at these figures. Mutual fund. They are continuously buying. They are continuously buying. And not just mutual funds, I mean, that is also mutual fund only. But look at the SIP inflow, month on month. So we are there. Now, if they are selling, what's the problem? 2 lakh crore or little more than 2 lakh crore worth of selling they have done in last, let's say 14-15 months. What's the problem? We are there. India is self-sufficient now. The fourth one was geopolitical issues. Look at the list. Right? Look at the list. And there will be probably 10 more in another 5-7 years, 10 years. So what are we worried about? Geopolitical issues. Russia, Ukraine or any such issue, war, right? So many times it has happened in the past. And look at the yearly return after that incident happened. We know America is the largest country in the world. China is the second largest country in the world. If you look at the list, you will realize that in 80% cases or more than 80% cases, either America is involved or China is involved. In 80% cases or more than 80% cases, such incidents, you will realize either America is involved or China is involved. They are first and second largest country in the world. So there will certainly be more on this list. 1 year, 2 years, 5 years down the line, there will certainly be more on this list. But life doesn't stop. We just looked at 21 years data. GDP, market cap, Nifty. We looked at 21 years data. Just look at so many are there in last 21 years. Lehman Brothers, global financial crisis, flash crash, this month I don't even know, fears about China's economy, recession, COVID, so many are there. And hence, I talked about focus area number 2. Focus area number 2. If there is a fall in a country like India, it's an opportunity to buy. In a country like India, India is a structural growth story. All of us know about it. 12.5%, 21 years CAGR. 14% Nifty CAGR. Recession fear or growth slowing down, especially recession fear in developed countries, especially US. Just look at last 8 quarters data. A country as big as US, almost 25 trillion GDP. Is it possible for such a country to grow at 35%? They've grown 34% Q3 2020. Then 4.5%, 6.5%, 7%. Their average has been 2 to 4% before COVID. I mean, look at the base, now 25 trillion, almost 25 trillion. Now, this quarter, certainly they have gone down. GDP has gone down to minus 1.4%. But can we be really worried about it? All of us know what happened during COVID, especially in developed countries. There was a lot of free money or easy money that was given to the citizens over there. So if I can share an example so that you guys can relate. Let's say I go to a small town, population you can say 1 lakh, right? And there are 4 or 5 or 6 or 7, 8 restaurants, in that town. And I give everybody 10,000 rupees. The next 1 month, you are supposed to eat out. Right? Understand there are 4 components in GDP. C, which is consumption. I, which is investment. Not investment in financial products, otherwise investment, building capacities. G, which is government spending. Right? Weapons for the military and other investment, so-called government capex. And the last one is X minus M, which is export minus import. Export minus import. C plus I plus G plus X minus M. Now, because there is so much liquidity, C, which is consumption, is going really high. But at this same pace, in no time, it is not possible to build another 10 restaurants. Just because people have got money and there were only 8 or 10 restaurants, another 10 can't be built overnight. Right? And probably there is no reason also. Because they have this 10,000 rupees. They don't know next time when will I give them money to eat out. So in the absence of I and G and X minus M at the same pace, there will be a quarter or 2 quarters when it will go down. And technically, 2 consecutive quarters of negative growth termed as recession. So next quarter, whenever the numbers come, if it is minus, again, certainly it will be termed as recession. Right? But one should not really worry about it. This is a very, you can say, extraordinary period, last 2 years for most of the economies. Extraordinary period. 35% US GDP growing in a quarter, 34% US GDP going down in a particular quarter. It's not possible. For that matter, 7-8% growth is also not possible. But there was so much free money that This is possible. Right? At the same pace, in no time, new restaurants or new capacities can't be built, and there's no need, as I said. Because this free money is not going to be there always. Why I'm spending so much time on this slide? Because next quarter, if again you hear, there's some news article that GDP growth has been minus whatever, right? And US economy is in recession. Please, please, please don't be worried. It's a technical recession. And 99% will happen. Next quarter GDP growth, 99%. 1% could be a little bit positive. 99% will come in negative only. Because there was so much liquidity in the system. So it's a transitory, you can say, period, transitory in nature. Inflation, this inflation is transitory in nature. Right? Now, there is one more, although probably not many people are worried about it now, but and not all the investors know about it, which is market cap to GDP. So the moment it goes higher than 100% or 150% to 120%, any number higher than 100%, again there will be a lot of news articles. Understand, there were only 2,600 or 2,300 companies listed 20 years back. That number from 2,300 has already grown to more than 5,000. From 2,300-400 to more than 5,000 listed companies we have now. If I exclude companies got listed in last 14 months, that this percentage from 93 comes down to 85, 86. Because market capitalization for companies got listed during FY 22 and 23 is almost 12 lakh crore. Right? Again, let's look at US. They are always more than 100%. Just about a year back, it was more than 200%. Now, even after correction, it's almost 200%, 198%. Market cap to GDP. The other big country, China, it was as low as 17% in 2005. And only once they touched 100% plus. Otherwise, it has been in that range of 50 to 70%. Again, what I am trying to communicate, it doesn't really matter. In a country like India, if there were only 2,300, 2,400 companies listed, today that number is more than 5,000. R&R is going to become a listed company in a couple of years, and likewise so many other. Right? How does it matter? How does it matter? This is now sectoral. 264 lakh crore total market cap as on 31st March 2022. Look at the sectors. BFSI right at the top with 20% contribution. Then IT, FMCG, pharma, healthcare, auto. Right? And this is what the top 10 sectors as in different years, 2001, 5, 11, sorry, not 11, 10, 15, 22. So they keep rotating. Total market capitalization in 2001 was only 6 lakh crore. Was only 6 lakh crore. To 16 lakh crore, to 62 lakh crore, to 101 lakh crore, and as on 31st March 2022, 264 lakh crore. So sectors keep rotating. We are mindful. We are looking at it all the time. We are trying to give you the maximum opportunities from the top performing sectors. But then there will be different times. So just quickly I'll show you one or two. This is banking, BFSI. I mean, BFSI, apart from banking, all the stock broking, asset management, housing finance, insurance. So just look at the growth. Now this is market cap for the entire sector. From 23 lakh crore to 50 lakh crore, from 16 lakh crore to 23 lakh crore. Sequential growth, right? But likewise, so this is the growth rate, FY 16 to 20. If we normalize it for that fall, which happened in March 2020, the growth percentage moves higher from 6.71% to almost 13%. And last, obviously, 21-22, it was as high as 48%. And all the stakeholders are there. Government is there, FI is there, DMFs are there. All the stakeholders are there. IT, more or less the same story, sequential growth, year on year. From 13-14 lakh crore to currently almost 33 lakh crore. Again 5% growth because of March 2020. We normalized it and went higher from 5 to 8. In last 2 years, 53%. In case of FMCG, the fall was not as deep, and hence after the fall in last 2 years, growth has also not been as high as other sectors. So it was 11% because of, as I said, fall was not so deep in case of FMCG sector, and last 2 years only 25% growth. Mainly 2021. When I say last 2 years, most of it is due to that 1 year, 2021, because the base was very low. So I'll just show you capital goods and realty. This is auto ancillary. So these are different sectors. Obviously, in the interest of time, I'm not showing you, each and every slide. The point I'm trying to communicate different sectors. There are so many sectors. We have taken top 10 sectors here, and there are other 20, 30 sectors. For 100% market capitalization, there are too many. So each and every sector, barring a few where the growth has been sequential, there will be a period, and I wanted to show you capital goods and the other one,
okay.
realty.
Okay.
Yes, this one as well. Just go to the next slide. Yeah, 1 second. So look at this. Minus 10%. If we look at 2016 to 2020, and last 2 years, 42%. Because of now, strong buying is there in stocks like Tata Power. There is this new stock, Adani Green, right? Most of us own it probably. We don't own it at least. I don't own it. But yeah, there is a lot of interest in stocks like this. So from minus 10% to 42%. Go on. Go on. Again, realty sector, there was no growth. During this 5-year period, not much was happening in this sector. But last 1.5 years, this sector has also done well. This one is the most interesting one. So now as an investor, what we look at, it was 149 lakh crore, the sector market capitalization. And currently it is 445 lakh crore, almost 3 times. Just go to the next slide. But look at this, 5-year period, minus 9%. And it's, as I said, part of it is mainly that March 2020 wala fall. Due to that fall, this minus 2% went down to minus 9%. But even if we look at normalized return, it was minus 2%. If we exclude March 2020 fall, if we look at data till Feb 2020, it was minus 2%. And last 2 years, just look at the upside, 72, 73%. Let's go to the next one. The next, that's it, 1 second. So this is what we should look at. In between, there will be rotation, certain period, let's say 2016-20, capital goods didn't do anything. Next 2 years, it was the best performing sector. BFSI, IT, FMCG are 2 or 3 exceptions. When the growth was sequential, year-on-year growth, right? Most of the sectors, they will deliver good upside in a couple of years, and then there will be a dull period, and again the upside will come. What we do at R&R, we are looking at this data very closely, as I said, but don't try to time it this way that because capital goods is doing well, 72% growth or highest growth in last 2 years, why I don't have too many capital goods stocks in my portfolio. This particular sector or this particular company not doing well, why I have this company in my portfolio. It's not possible. One should not do that. And hence, if you look at data for 20 years, the range is, again, market capitalization growth is in the range of, I would say, 20%. Capital goods, despite that stellar performance, 72% in last 2 years, is at 16% year-on-year market capitalization growth. Otherwise, 20-odd%, most of the sectors, at least the big ones, top 5-6 sectors cover 50% of the market capitalization. So top 5-6 sectors have grown in terms of market capitalization almost 20%. Huh? BFSI was little higher, it is here 21%. 21%. Go to the next one. Now, this is interesting, and second last slide. This is US GDP, US market capitalization. So, market capitalization was almost $52 trillion before the fall. Now, after the fall, it has come down to $42 trillion. Market cap to GDP, we discussed, currently is in that 190% range. The reason why I'm showing you this, and the next slide, go to the next one. This also, but the next one, that's it. Reason why I'm showing you that slide and this one, there are companies which are worth more than $1 trillion, $2 trillion, right? Total population is almost 300 million. Market capitalization after the fall also $42 trillion. Companies, one company is worth $1 trillion, even $2 trillion. Why can't we do it? We are currently $3 trillion GDP and let's say almost $3 trillion market cap. There are companies in US, one company is worth $1 trillion, $2 trillion. GDP is almost 25 trillion. I mean, it was 25 trillion, now it's come down a bit. Almost 25 trillion it was. Market cap $45 trillion. So we need to believe in this opportunity, all I'm saying. There's a lot we can do as a country. There's a lot we have there for all of us as an investor. What we need to do? We need to believe in this country. What we achieved as a country, I have discussed data for last 20 years. Why all our worries are not very tangible. We have looked at that as well. right? What we are going to do, we are going to achieve in the next 10 years is what my colleague is going to cover. In the next 10 years, what India is going to achieve, my colleague is going to cover. Just look at that. But I truly believe in this opportunity. I'm certainly not worried about anything we discussed. Because I know, as a true Indian, if US can do it, for that matter, China can do it, 3 trillion export, 3 trillion. Why can't we do it? If US can do it, China can do it. We are growing at 12% year on year, so many years. We have so many businesses, good businesses. So many got listed in last, 15 odd months. There are many more. There will be a few very good ones and few not so good. That's fine. But we can certainly become a 10 trillion economy. We can certainly become even bigger. We can certainly reach 10 trillion market cap, or more than that. Or more than that. It is more than possible. So I truly believe in that. We truly believe in that. After the event, as I said, please do mention, after looking at all the presentations, if you also started believing in that. Thank you.